Welcome to Retirement Income Without All the Risk. Now, if you're looking for the presentation about income with all the risk or investing with all the risk, you've come to the wrong webinar. This one is about retirement income without all the risk or investing without all the risk. Brought to you by ATX Financial Planning, where we are innovative, tactical, personal, and risk alert to retirement and beyond without the sleepless nights. I am Mike Massey, your host and presenter, and let's get into the presentation. All right. All content is for information purposes only and should not be relied upon for any investment decisions. It is not intended to provide any tax or legal advice or provide the basis for any financial decisions, nor is it intended to be a projection of current or future performance or indication of future results. This requires a review of an investor's objectives, risk tolerance, and time horizons. Investing always involves risk and possible loss of capital. Nothing mentioned in this presentation should be taken as a recommendation. You're encouraged to consult with your own legal, tax, and financial professionals for specific advice or product recommendations. If you have at least $500,000 in investable assets, then we invite you to schedule a no-fee, no-obligation meeting to meet with us via Zoom or in person. Okay, let's get started. So the real risk is on the backside, going down, right? On Mount Everest, do more people die on the way up the mountain or on the way down? In fact, more people die on the way down, the descent, than on the way up, the ascent, when above 8,000 meters, at a rate of 5.6 more. On a staircase, are you more likely to have a bad fall if you trip going up the staircase or going down the staircase? I would argue going down the staircase. What about retirement? Are market downturns more painful leading up to retirement, or when you're pulling the money down from your portfolio during your retirement? What about drawdowns before retirement? Still time to potentially catch up. Work longer, spend less, save more. But drawdowns after retirement? No longer working, and time is not on your side. The retirement you envision. When you think of retirement, what words come to mind? Freedom, peace, joy, travel, hobbies, legacy. Yes, you're over here. Rarely do people imagine stress, moving in with kids, rejoining the workforce, sleepless nights. But without a good plan, those fears may be real for some. Exploring drawdowns. Over 50% of the time from 1980 to 2021, S&P lost 10% or more intra-year. That means during the year. S&P 500 drawdown during 2008 was 48%. The S&P 500 decline from October of 07 to March of 09 was 56.8%. And from January 2022 to October 24th, 2022, the Bloomberg Aggregate Bond Index, hear that, bond index lost 15.78%. You heard that right. Bonds went down over 15% from that time frame. Long-term treasury bonds lost 34.8% during that time frame. So what emotions do you feel when you hear that? Do traditional investments give you peace of mind? Stocks. Now, most people love the upside, but how about the downside risk, the drawdowns, the volatility, and bonds? Some people feel safe with bonds. How about you? Did you know that there's a 65 to 75% chance, a likelihood of success in retirement if 100% in bonds, living on 4% inflation-adjusted withdrawals? But that likelihood of success drops to only 5 to 10%. Out of 100%, only 5 to 10% if you're withdrawing 5% annually. These are serious numbers to consider. The silent killer, of course, is inflation, and it's a reality. It averaged 3.8% from 1960 to 2021, and 7.25% in the 1970s, and 8.5% from August 2021 to July of 2022. Retirement income must rise to keep up with rising prices. Fixed income is shrinking income due to inflation. Inflation is like compound interest, but in reverse. Are there any other options other than just traditional stocks and bonds? I'm glad you asked. Actually, I asked, but let's not argue about it. You see, here's my daughter. She was learning to ride a bike over here on the concrete. She was fearful. She didn't want to crash. She didn't know what would happen. She knew she could get hurt. She was very insecure about it, and she was anxious. So you know what? God gave me the idea. He said, put her on the football field. I'd never done this with any of my kids. We put her on the football field. She had padding if she fell. We had a plan in place. There was protection. She wouldn't get hurt if she fell in the grass. She trusted me from the past, and she trusted me in the present at that moment, and we made forward progress. And I mean, she learned to ride her bike like that, like the first or second push within 30 seconds, and she was cruising. Now, she couldn't go as fast as she could go on the concrete, but she didn't need to. She learned, and because she learned and did better, look at the smile on her face. She did fantastic because we put protection and padding. It's like little airbags for her bicycle, the grass was. So one option is index annuities with lifetime income. Do you love them or do you hate them? Some index annuities may offer income for life regardless of market declines and regardless of how long you live. But each contract is different, so we can discuss offline if you're interested. But some people hate annuities because they have a surrender period, maybe 7 years or 10 years or longer. And some people just don't like commitments that long. After all, most marriages only last 7 to 8 years. But this presentation is not about annuities. But I had to mention them because they are an alternative to traditional stock and bond investing that may help some investors with managing downside risk or creating a lifetime income, potentially. But we can talk about that offline. Let's get into the meat of the presentation. Enter buffered funds. Lots of varieties and names. Buffer ETFs, defined outcome ETFs, floor ETFs, structure protection ETFs, outcome ETFs, buffer ETFs, etc. There are lots of different names and varieties, and even more unique names, thanks to copyright laws, commonly referred to in the industry as buffer ETFs. Hats off to innovator funds who trademarked a lot of these words and phrases because they were one of the first to market. In fact, we use a lot of innovators' literature in the following slides in this presentation, and we tend to use some of their ETFs. But we also use ETFs and funds from many other companies. And we're not affiliated with any ETF company, and nothing we say in here is a recommendation for or against anything. There are hundreds of options available, over 325 buffered funds available in the industry, and it has had explosive growth from just 4.6 billion in 2020 to 54 billion plus last August 2024. Huge, massive growth and appetite for this. You can book a meeting with us online. You can visit our website, atxfinancialplanning.com, or you can go to calendly.com/ATX Financial Planning to book a meeting with me or with my partner. Just add on Dallin at the end of the phrase. You can use our account aggregation software. You can listen to our podcast. Take a picture of this with your phone. We'll show it again later, but it's great. You can grab it now. The building blocks of buffer ETFs. They have 4 components. Upside potential. This is the maximum return the fund can earn over the full outcome period. Built-in buffer. This is key. The initial amount of loss the fund seeks to protect against over the outcome period. Third, the outcome period, the time over which the defined outcome is realized. Most ETFs out there in this space do 1 year, some do 2 years, some do 6 months, some quarterly, some monthly. And the reference asset, the asset that the fund return is based on, like the S&P or the Russell or technology or international or even Bitcoin. What are buffer ETFs? They're revolutionary risk-managed investment solutions designed to provide a targeted level of downside protection with upside participation up to a cap over an outcome period. So basically you have this upside cap. Here they're showing this line here. So if the reference asset kept going up, your maximum gain would be limited to that cap over that outcome period. The downside buffer. This particular one is showing that you're protected against the first X percentage of losses. So while the reference asset's going down and losing, you're not losing anything because you're protected. After you get beyond that buffer, then you start losing. But if this was down, say 20%, this is down less than 20% because you had that buffer. There's an outcome period. What they're trying to arrive at is this cap and this buffer over the outcome period from the start date to the end date, which is usually a 1-year period. Then there's a reference asset, which is what it's tied to. Losing less matters more. So let's just say that a reference asset, with no buffer, traditional unlimited upside, downside all the way down to losing 100% of your money, going down to 0. If it went down 5, and you were in 100% buffer, that means you were protected on 100% of your losses, not including fees or expenses like fund fees or advisory fees, for example. Then you would have 0 losses. And if the reference asset went down 50%, you would have 0 losses because you're protected on that entire thing. And now, what about making up those losses, right? If an asset went down 50%, a reference asset, so $100 went to 50. Well, in order to get back to that $100, it has to go up 100%. And that's why you see this 100% here. Went down 50, needs to go back 100 to get to break even. Whereas the 100% buffer, no, it never went down anything over that outcome period, so it has nothing to make up. So this chart gives you an idea, and it's trying to emphasize that losing less matters more. In retirement, I've found that many people want to focus on keeping their income, keeping their money. They're more focused on that than trying to get rich, because most of them have already gotten rich in their eyes, whether that's $500,000, 5 million, 50 million, it doesn't matter. Rich is relative to people and their lifestyle. And let's look at some benefits of a ETF wrapper. Cost efficiency. These things have cost efficiency. If you were to go out and buy these option strategies, discounted, zero coupon bonds, puts, calls, different things, different companies package them differently. You could have a problem from a cost perspective. These are cost efficient. I've seen a lot of these that we tend to use in 69 basis point, 79 basis point, 85 basis point range. So that's like 0.65, 0.75, 0.79, 0.85, somewhere in there. So very cost efficient. Tax efficient. If you were going to go out and try to replicate the strategies with these put options, call options, spreads, collars, etc., you'd probably have a lot of taxable events along the way. Whereas inside of this wrapper is essentially tax deferred and just continues to push out that taxable gain until the point that you sell it. So very tax efficient. Intraday liquidity. You can get out anytime you want during the day because they're ETFs, which means they're tradable on the market during market hours. You can go in and sell them. Transparent. You can look at the fact sheet. You can look at the prospectus, find out what's under the hood so you know what's going on. A lot of these companies will even post on their websites what the current cap is, what the current buffer is, because a lot of time you won't be buying it on the day it comes out, but sometime during the period, and you'll have transparency of what that looks like at that point in time. And there's no credit risk, which is huge and so different from some other things out there. You get defined return and risk parameters, point to point. Like I said, most of them tend to be 1 year. Easily accessed and liquid, cost efficient, transparent, ability to manage them because you can buy and sell, you can trade in and out of them if you want to. Of course, you may have a taxable event at that time, unless you're in a tax-deferred account. No credit risk, which is huge, and no commission load, tax efficiency. And just to throw it in one more way, because I really want to drive this home, the upside and downside is known prior to investing. You can remain invested, and you have reduced risk of market timing. They're cost-effective, no credit risk, liquid, no minimum investment required, tax efficient, and no lockups, no commissions, and no surrender fees. Pretty cool. So maybe you're one of these people. Let's just voice some of these thoughts that maybe you say, I want to participate in the market with built-in buffers against losses. All right. I can't afford the risk of equities, but also can't afford low yields of fixed income. I'm looking for a potential alternative to other structured outcome investments. So maybe these resonate with you. And if so, maybe we can dive deeper into this through a call and having a conversation to see what may suit you. I don't know. We need to look at your risk, goals, risk tolerance, desires, all that stuff. You can book a meeting. Again, take a picture of this or snap your phone if you're watching this on your phone. Try to do that, capture deal with your phone so you can have the screen for later. Here's some investor concerns. They're worried about market sell-offs. Well, buffer ETFs offer known downside protection, enabling clients to maintain their investment strategy with resilience during market volatility. Maybe someone's holding too much cash. Well, you could avoid the cash drag and instead put cash to work in buffer ETFs to access higher potential upside to a predetermined cap with built-in risk management. An investor concern may be questioning the safety of bonds, where the 2022 market environment reminds us that bonds may experience negative returns. Buffer ETFs offer known levels of downside protection with no interest rate or credit risk. Maybe afraid of investing at high stock market valuations. It's impossible to time the market. Buffer ETFs can help give investors the confidence needed to invest. And a retiree or pre-retiree wanting to take more measured risk. Buffer ETFs may serve as a core equity solution for investors who aren't looking to take full equity market risk. So you see, here's maybe just a random portfolio. Here's some bonds, here's some stocks, and maybe they add some buffers here. They have a known built-in buffer without taking on the interest rate, credit, or default risk of bonds. Do you hear that? They don't have the interest rate risk of bonds, they don't have the credit risk of bonds, and they don't have the default risk of bonds. We talked about the different flavors, and you got buffer ETFs, which basically over the outcome period give you growth potential up to a specified cap of a reference asset with built-in buffers of a certain percentage against downside loss. There's another variety, which I'll just call here managed floor ETFs, that over the outcome period seek to offer growth potential uncapped, but with less than 100% participation of a reference asset and a targeted floor that aims to limit losses roughly to the level of the floor. Again, we're not going to go into the nitty gritty, get deep under the hood in these things. We can talk about that during the meeting, or you can talk to your financial advisor about this or do your own research. I'd love to have a meeting with you if you have at least $500,000 in assets. Let's look at 100% buffer ETF with 100% downside protection. Designed to protect equity upside, to provide equity upside to a cap with 100% downside protection. Yes, you heard that right. You can invest excess cash. It's tax efficient and there is no credit risk. Let's take a look at an example. The darker line is the reference asset. And let's say it ends the year from the beginning of the outcome period to the end of the outcome period. Let's say it ends negative. Well, this one that has 100% buffer says at the end of the outcome period, you are buffered against 100% of those losses. So you'll have all your money there, not including any fees or expenses such as ETF fees or advisory fees, which would reduce it below that 100% level, but it seeks to deliver before fees and expenses that 100% level, that 100% downside buffer ETF protection. Now in the event of the upside, so here it shows the reference asset going up over that outcome period, and your 100% buffer ETF goes up and ends the year, but can't go beyond that cap, right? So you're capped out, but that is something to consider. And this flavor is even available tied to Bitcoin. Calamos has several of these. Here's the January series. It offers upside exposure to Bitcoin, built-in downside protection level over the outcome period, which is with this particular series is a 1-year outcome period. They actually have 3 different flavors. One that has 100% protection, like the slide we just talked about, with upside opportunity up to a cap. If you're willing to take on a little more risk, this one has 90% protection, so you're subject to 10% losses because 90% is protected, 10% is not, and you'll have more upside potential because you have a higher cap. And then there's a third variety that gives you 80% protection. So now you're naked on 20%. You could lose up to 20% over that outcome period, but because you have more downside or less downside protection affords them the opportunity to give you more upside opportunity with a higher cap. So the more protection, the lower the cap. The less protection, the higher the cap. You could pick which one you like. You could blend them, buy 2 of these. You could blend them and buy 3 of these. So for risk control, offers defined levels of protection on Bitcoin exposure for investors unwilling to risk market downturns. This says, as a portfolio diversified, Bitcoin has exhibited a low correlation in both traditional portfolio and traditional diversifying assets like equities, fixed income, and gold. So maybe you own some Bitcoin, but you're still not comfortable with all the risk. Maybe you've wanted to own some Bitcoin, but you're not comfortable with all the risk. Maybe you like the idea of diversification or, an asset that's not fully doesn't have all the correlation of typical traditional equities and bonds. And this may be a way for you to get exposure with some protection on the downside. Again, this is not a recommendation. We're bringing this to light. You do your research. We'd love to have a conversation with you and see if it may make sense for you. You see, we have knowledge and experience with buffered ETFs. We are aware of buffered ETFs. We utilize buffered ETFs. We have access to most, if not all, of the buffered funds. We have spent hundreds of hours studying buffered ETFs. We have researched and utilized various buffered ETFs and funds for many years now from different companies. And we would love to have a personal conversation with you about retirement income planning and to show you how we might use buffered ETFs to fine-tune your retirement portfolio, your retirement plan, your peace, and your joy. A little bit about us. Why hire ATX Financial Planning? We are fiduciaries, so our interests are aligned. We have transparent fee structure that is tiered and not blended. That's big. We're independent and honest. We're not Wall Streeters. We use financial planning using statistics, not a napkin. We can give you a portfolio audit, so why not get a second opinion? We're innovative. We're not stale and outdated. We have tactical abilities to help weather storms. We're very personal, not a big impersonal firm with high turnover. And we're risk alert, offering some strategies with downside protection. This presentation, right? This is where we are. So now what? You just learned about some of the most innovative tools for retirement planning and financial planning. The question is, what will you do about it? Will you stay on the same path of traditional stocks and bonds? Will you ignore innovative buffered funds that can be liquid, tax efficient, and offer downside protection? Or will you take 45 minutes to get a second opinion? You can book online. Book with me at calendly.com/ATX Financial Planning. Book with Dallin, my colleague, at calendly.com/ATX Financial Planning Dallin. You can use our aggregation software and you can listen to our podcasts. Just 45 minutes. You probably spend 10 to 20 hours planning your next vacation. Don't you think it would be wise to spend 45 minutes with me to get a second opinion on your retirement journey? There's a bonus offer. If you have at least $500,000 in investable assets and you're one of the first 5 people this week to book a meeting, then we will give you a Social Security optimization report at no charge. It's not some generic report that leaves you with more questions than answers. It's a customized, tailored report specific to your situation to optimize your Social Security income. A second bonus offer. You can sign up for our aggregation software. Stop wasting time with financial planning, with financial spreadsheets. Let aggregation software do the work for you. You can link your bank accounts, your card, your investments, your stocks, your property, your homes, your loans, and it'll give you your net worth. And a lot of those actually get updated daily, like bank accounts and investments typically do, not house prices. And this is using a very secure and encrypted software. And there's no obligation, right? No obligation to do any business with us. You can just use this software, and we're not charging anyone for this software right now just to have access to it. So book now. Our calendars do fill up quickly. You see the link for myself. You see the link for Dallin. It's a no fee, no obligation second opinion. 45 minutes could change your life. And come listen to our podcast. It's the Buffered ETF Guys podcast and ETF Investing with Airbags. Welcome to the podcast. It's for investors who want to get retired, stay retired, and stop stressing over the next market crash. Bear markets happen, but so do bull markets. So why not be prepared for both? Buffered funds offer downside protection and upside growth so you can protect, grow, and stay rich. They're like ETFs with airbags. We could focus on timing the market, but we'd rather teach you how to spend time in the market. Get financially buff and retire well with the Buffer Guys. You've seen these links. Take the one last picture. Make sure you have these so you can book it, or just go to our website, atxfinancialplanning.com, and you'll see all these links. Here's additional disclosures. We are so grateful that you joined us today. Book a meeting. There's no obligation. Let's have a conversation to see if any of this makes sense for you. Let's see if we even fit well and match well together. Thing about retirement, again, is that's the backside. Getting to retirement is the easier part for most people. Staying retired is the harder part with the same standard of living that you had before retirement. Because Mount Everest, most people die descending, not ascending. Going down the stairs is more dangerous than going up the stairs. And being in retirement is a more dangerous time than being pre-retirement, where you still have time to save and delay and take less vacations and stuff like that, reduce expenses. In retirement, people don't want to do that. You just want to stay retired. You want to have peace and joy and not be tied to the television or the financial news or what your stocks are doing for that day. So go ahead, book a meeting, call us. We'd love to spend time with you and just get to know you. We hope you enjoyed this webinar. Hope you have an incredible and a blessed day.